Hi guys, I'm Phil Town from Rule 1 Investing. Today I want to talk to you about stock splits, what that means to you as an investor. So what exactly is a stock split? It's exactly what it sounds like. If you have one share of stock and they split it, you'll end up with two. Now, they can do more than that, but that's basically what it boils down to. It's just a decision to have more shares out there so the stock can trade better. Stock splits happen from time to time. It's important for us to understand just kind of what they mean, how it might impact our investing decisions, because sometimes I hear people get really excited. Ooh, Apple's splitting 4 for 1. Buy Apple. Like somehow the stock split is going to make the stock go up. And you know what? Sometimes that's a self-fulfilling prophecy in spite of the fact that it is incredibly stupid. But let's explain. So stock splits, the different kinds are essentially that stocks will split 2 for 1 or 3 for 1. Apple is splitting its shares 4 for 1 on August 31st. Okay, so 4 for 1 means that if you have one share of Apple, when the stock split is recorded, you immediately have 4 shares of Apple, and all of the numbers of Apple for all those years in the past are split 4 to 1. So if Apple's stock price was at $400 a share, it immediately the next morning opens up at $100 a share, because now it's got 4 times more shares, and all those extra shares don't add 1 cent of value to the company at all, not for any reasons other than emotional. Now, the reasons they might do it is because shareholders are emotional. And, there's some valid reasons why you want to have a lower price stock. The main couple are that it's more accessible to small investors. And I think Apple knows that it's attractive to younger people who may not have a lot of money. So when the stock is at $500 a share, somebody with $500 can buy 1 share. Right? Somebody with 1,000 can buy 2 shares. And maybe they feel like, maybe I don't want to be so fully committed with my $1,000 portfolio to just one company. Well, stock splits down to $100 a share. They can buy a couple of Apple shares and have room to buy other stuff. Now, the other reason that's pretty valid is that option prices reflect the underlying stock price, but at a multiple of 100 shares per option that trades. So options trade in contracts, and there's 100 shares per contract. So if Apple is at $500, in order to be able to do an option on Apple, you've got to be able to deal with 100 times 500, which is $50,000. When splitting back to $100, they make that $10,000 instead of $50, and it allows options traders to get a little bit more option trading going on in the stock. And finally, there is the really loony reason, which is that, and that's the one most people buy into, which is that it's going to increase the share prices. And amazingly, it sometimes does. And it actually did immediately with Apple. As soon as they announced their stock split, the price went up, as if somehow dividing your pizza, instead of in 4 pieces, it's in 8 pieces, and it's worth so much more now because it's in 8 pieces. And wait, if I want to make it even more valuable pizza, I'll split it to 16 pieces, and it's so much more valuable. In other words, somehow these people think the pizza is getting bigger because they split it into more pieces, which is really stupid. But who said people in the market are rational? They're just doing stuff for emotional reasons, and sometimes it works. All right. So does a stock split impact your investment if you already own the stock? It shouldn't, because your investment should be the value of the entire business, no matter how many pieces it's split up to. Just like if you buy a $14 pizza, it doesn't get bigger by stock splitting or by splitting the number of pieces. Now, there's another kind of stock split, which is called a reverse stock split, where you are ending up with less shares than you previously started with. Like, let's say you had 100 shares and they reverse split it 10 to 1, you suddenly have 10 shares. And the reason that they would do that is because there are limits at the bottom level on how much the shares have to sell for in the stock market in order to trade in the public markets. And they will delist a company if it is trading at lower than, in one of the markets anyway, $5 a share. So if it gets under $5, they can reverse split, remove a bunch of shares, and the stock price goes up. Does it increase the value or decrease the value? No, not at all. So should you buy before or after a stock split? Or does it even matter? Come on, if you're going to trade based on stock splits, have at it. It's not what we teach. I'm not saying it doesn't work from time to time, but it isn't what we do at Rule 1. We look at the company not per share. We look at it on the whole company the way an owner does. When you learn to invest like we do, you're acting like an owner, not a stock speculator. Now, what I'd love to hear from you guys is, what other investing terms would you like to see in future videos now that I've, blown up your understanding of stock splits? Leave a comment below with your answer and I'll be sure to follow up with you. Thanks for watching. Now go play. Hey, if you enjoyed this video and you think it was valuable in teaching you more about stock splits, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And by the way, don't forget to click the button on the screen. It'll give you a free gift. And thanks again for watching.